Okay, brilliant. Thank you.
So we are on and recording. Great, guys. Well, certainly we have been waiting for this day for a long time. You know, we are so aligned in so many ways. We are both speaking exactly the same language to our clients. And it really is a great honor to be aligned with you guys, Magnus, and thanks for coming and joining us on the call this morning. I would love this to be much more interactive, but there is obviously quite a lot of information that I think we need to share. I'm sure that a lot of you already know something about Orbest, but I think for the benefit of everybody, maybe it's worth just starting from the beginning, giving a little bit of an insight as to who we are, what the business model does, how we do business, and perhaps Michiel can tell us a little bit about the individual buildings of the real estate that we do. So Brian, perhaps does that make sense to you, or would you just like it to be more interactive, more Q&A, or maybe I can just do a few slides and we can stop and do some Q&A and see how it goes?
Yeah, I think so, Justin. I think go ahead, and if there's any questions, we can obviously sort of have a Q&A at the end.
Please, guys, yeah, if you don't mind, just mute when you are not speaking. And if you want to speak, who is that background noise there? If you want to speak, just unmute and shout, and I'll stop presenting. So just to kick in, first of all, with and I'm going to do this slightly differently to how we normally do it. I'm going to go and introduce you to the people on our side who are online today. And first of all, Michiel Lucas, who I'm sure many of you have already met. Michiel is based out of Pretoria, and he's the infamous fellow that travels to America on a regular basis, although not so much this year, and acquires all of these buildings and has been doing so for actually over 6 years, long before Orbest, and has actually assembled our entire portfolio so far. Michiel is an ex-Siemens engineer, and you'll see that coming out when you engage with him in the future. Everything is very rigid and in a box, which is fantastic for somebody who has to acquire and motivate for us to take on these buildings, and of course, oversee the management of the buildings through our asset management team. So we will introduce Michiel in due course. But who I'm going to ask to do the introduction is Martin Friedman, our CEO, who sits in New York. And you guys are all in the financial services game, so I'm sure you will know him very well. He is renowned for building and scale a few very interesting businesses, including Bayport Financial Services. But before he explains to us a little bit about how Orbest operates, what we do, what we focus on, and what we think clients are particularly interested in with our product. But before we do that, just the others. Lo Viljoen is our CFO, based out of Cape Town. He has, in his previous career, he has been the financial CFO of a listed company in the real estate space. And myself, I'm probably best known for starting, founding, and building private property.co.za and One Africa Media. But really the most important person in our team, who is an avid supporter of Magnus and I know is more recently an investor, is our chairman, Henny Bezuidenhout. Just for those of you who don't know, he has most probably the biggest portfolio of privately held medical real estate that he's assembled over the last 28 years across South Africa. Many of the buildings that you might have actually visited next to your hospital are actually owned by his Benchmark group. He operates out of Pretoria, out of the Centurion area, and I would really love to bring him onto a call one day to tell you a little bit about medical. But to get going on the real topic today, let me introduce Martin Friedman, who's woken up very early in New York. I think it's about 4 a.m. there, Martin. And please come in and tell us a little bit about who we are, what we do, and why we're around.
Thank you, Justin, and thanks everyone for joining us on this update and webinar this morning. And so really, myself, I immigrated to the US 3 years ago, specifically with the goal of heading up Orbest and growing it into a global real estate company. I'm based out in New York, And yes, it is early in the morning, but my pleasure to be up and be online with everyone from Brenthurst. And so a bit about Orbvest. Orbvest's journey began many years ago, where we wanted ourselves to diversify our own money, invest offshore, which I know is a very strong point from Brenthurst, and to basically make sure that we could invest our own wealth into just stable investments overseas and make sure we could just get dollar dividends if possible. And so we looked at various countries. I know certainly I did. In terms of Australia, where your cash on cash is very low, you are really banking very much on your capital appreciation when you sell the building. The same as in London. I actually own some property and some real estate in London. And what happened was I ended up migrating towards the US, where you get this nice balance between cash on cash and also then a profit when you sell. And those two together, the cash on cash and also the profit, are known as your IRR, which is your internal rate of return. And it was over the period, I'm talking 2012 onwards, that I started to find my partners who were doing the exact same thing, from Michiel, who was actually buying real estate in the USA, to Justin, who was looking for the same thing, and then Henny, etc. And so that's how we came together. It was very much a selfish initiative. We were doing it for ourselves and a few other people we knew. And we very quickly realized that this was an enormous opportunity that most people in the world outside of America, and that includes specifically South Africa, would love to find a place and a team who could help them invest overseas into the United States. What we then realized is that America is a very large place. You needed to then focus, and we'll talk a little bit more about that, and also the niche. But just specifically, high level, we're a global real estate company that invests only into the United States and only in the healthcare niche. And we basically assist people from around the world, and specifically over 10 countries, doing that. Thanks, Justin.
Martin, I think if you can just carry on a little bit and talk to how we actually operate, how the model works.
Perfect. So the way that it works is that we go into certain states, and these states all have to have very strong fundamentals. These fundamentals are, for example, population growth. So if you talk about places like Texas and Florida and Arizona and Atlanta, Georgia, enormous inflows of population. And that, together with it's been there a long time, it's in a strong location. They say sometimes location, location, location. That's what we seek. And generally, if you overlay that with the fact that you've got a building, a medical building, the important aspect is it's either got to have a very long lease or it's got to be multi-tenanted. Why also medical? And I'm going to expand on that now. If you think about your doctor or dentist, we always say, in any country in the world, not only South Africa, ask someone how many times that person has moved in the last 10 years, and they will probably say to you once or never. They're very, very stable tenants. They're profitable tenants. They've been there a long time. They don't want to go anywhere else because their entire client base is in that area. So if you put these people together in a building, it makes a very compelling proposition. The next thing I want to chat about is the leases. In South Africa and around the world, if you're in residential, people will sign, for example, a 1-year lease. If you're in commercial real estate, they'll sign a 3 to 5 year lease. It is completely common in the United States that people will sign actually between 5 and 20-year leases. It's phenomenal. So you've got these people that just stay there forever. So hence we believe it is a very solid, resilient asset class, which is able to generate returns of plus minus 8% cash on cash dividends. We pay those out quarterly, and then total returns of 11+% in terms of IRR. In fact, our actual target is total returns of between 11 and 17%. And our team has pretty much done that consistently for 6 years since 2014. And that's the reason why our reputation continues to grow from strength to strength. We're not new kids on the block. In exactly 2 months' time, we'll be doing it now for 7 years. And it's all about just finding these great buildings in stable locations.
Thanks, Mark. Great intro. So just to summarize our portfolio, and this should be updated. We've just listed one, and one of our mini portfolios is coming on now. We're over 350 million. We have about 1.3 million square feet under management now. Our targeted IRR, as Martin said, 11 to 17%. And this very interesting investment structure, which perhaps we'll touch on a little bit later, allows people to invest from as little as 5,000 from their first investment, and then we can actually drop it down. In order to reinvest your profits, we allow a reinvestment down to $1 million. The intention of the company is for us to move out of the Seychelles. We are a listed entity as Orbest, and bear in mind that Orbest is very separate from the investments. But ultimately, the plan is to move to New York, and Martin's ambition is to put us on the NASDAQ, which is why our offices are situated very close to Wall Street already. So an ambitious plan, but I think that's just to frame who Orbest is.
Justin, I think that just on that slide, just to give everyone a sense of where we're tracking on our plan, and it's not that we are driving growth, because we're not. We'll only buy a building in the right place and purchase it if it's the correct building. Henny and the investment committee really are paranoid about getting the correct buildings. But it just so happens that because of what we're doing in our strategy, we were expecting to be raising equity from 10 countries by 2023 and a $500 million portfolio. I think it's fair to say we're already over the 10 countries, and we probably will hit the $500 million by next year. So we really are providing a great service that we think fits what people are looking for in the world, in terms of specifically the strong cash-on-cash component, which I think is a very, as we say, compelling proposition for investors.
Michiel, perhaps I would like to just bring you in at this point. I think you've got to understand Michiel's job is to go and find these buildings, but when he finds the building, he has the very frustrating task of trying to motivate this investment committee to allow us to present the building to the public. And Michiel, perhaps you can just talk about David van Drach and Ellen Kleinoch, seeing as you have the most experience dealing with them on a daily basis.
Yeah, thank you, Justin. Our process internally requires that we need to submit our proposed acquisition to an independent investment committee. This is very important for us. It really differentiates us from a lot of other platforms, in the sense that we really would like to vet these projects. So I think the natural question for us was how to actually do that process, and also to add absolute credibility to that process. So it doesn't help you have judges that is not experienced. In our specific case, our independent investment committee consists of these three gentlemen, and I think the two external people that is really completely independent is David van Drach. David van Drach is an absolute veteran in the South African sphere. He's been for more than 30 years with banks and banks committee, and most notably he was with RMB Investec Bank, and he is actually launched in parallel the original RMB private bank, and then went on to actually be the founding members of the Ashburton funds that I'm pretty sure you as investment advisors knows about. So extremely credible. I just found it unbelievably how accurate he can sum up a deal. And then secondly, Ellen Kleinoch, we know him as Mr. Fix-It. He's got a very strong background in looking at developments and projects that has gone skew, specifically in the South African market. And so from that perspective, he has been very practical from a leasing and a property management perspective, extremely strong. The parallels from the South African to the US is virtually one-on-one. And then similarly, our chairman, Henny Besuidenhout, that has been in the medical hospital industry in South Africa for a very long time. For those that doesn't know, he was instrumental in restructuring the medical aids as we know it, in terms of discovery, MediHelp, and all of these things. Some of those concepts was his brainchild. He went on to develop a lot of day hospitals in South Africa, and the attraction and the know-how that he's got in the South African industry can be directly replicated in the US. The US is also a private health industry. South Africa up to now it's obviously going to change a bit, but as opposed to Australia and England, where that is public healthcare, the parallels to the US is virtually the same. most of our tenants, clients, the doctors, the patients obviously are insured in the US, both from the state side, which we call Medicare, Medicaid, and most of them have actually private health insurance. So it means that the health insurance pay model exactly is almost identical to South Africa. So the affinity for us from a know-how perspective and changes in the industry perspective is virtually the same. And we've been using that and leveraging that to maintain that we buy the correct type of buildings. We're not buying buildings, we're actually buying the income streams. And it's very important to understand the potential changes in the doctor's world so that we can maintain that income stream. And this is, I think, where these gentlemen is really keeping us on the straight or narrow. Believe me, sometimes me and my acquisition team, we are quite bullish about a certain building, and then they are very clear risk adverse, and sometimes they do say no. We had the cases where we launched a product and we pulled it back. So from our perspective, we're very comfortable that, you know, once we've gone through this rigorous process, the products that's on our platform really carries the obvious name, and obviously the due diligence has been done. So I think that's a very, very important side of our business.
Thanks, Michiel. We understand your frustration. I just want to touch a little bit on our investment hypothesis, and Martin covered a bit of this, so I'm going to be very quick. Particularly, we started off by looking at states with the fundamentals that are key to medical real estate. And those are, as Martin mentioned, number one, population growth. Number two, GDP growth. Number three, a high degree of aging population. And I think that's very important. If you look at these states that are highlighted, you'll understand that the people that are aging in the East tend to be moving down as they retire to the states along this coast. And you will notice that there's a massive migration of elderly people towards these states, particularly Arizona, Texas, Florida, Georgia, and the others that are highlighted. And then, of course, there's a few other things that are interesting and very relevant to medical. They have a thing called a certificate of need, which means that you have to apply before you can start your particular speciality in a certain area, which is like an EIA, very expensive to set up and very time consuming, and that locks the doctor into the building. And we really like this, and certainly in Georgia, it's very predominant. And of course, finally, the other thing is malpractice liability, which tends to congregate a lot of the medical companies and highly specialized hospitals, etc., in the states that have this malpractice liability. So I think you're getting the idea that it is fairly technical, and these buildings are especially specialized. Up till now, the three states that we've got buildings in, and we have two now in New Jersey. You can see that we very much focus on something. We get to know it very well, and we acquire in that area because we know it. Investment committee, after significant motivation, has allowed us to move particularly into Arizona and these other states. So we are targeting first Florida and Arizona, and we have our first couple of buildings coming up now in Arizona. I'm not going to spend too much time on this, but in the US, the thing is medical a large sector? And I think we need to understand the difference between hospitals and medical office buildings. Hospitals are a declining asset class. And why I say that, because the amount of inpatients going into hospitals is declining, and the amount of patients going into medical office buildings as outpatients, in other words, going in for the day for a minor procedure or a consultation, is increasing. And that is mostly due to technology. So without spending too much time on that, our sector is this yellow bit here, which is predominantly the outpatient sector, or what we call medical office buildings. It's worth about 420 or 500 odd billion now, 36,000 odd properties in the sector. So certainly, we're just scratching the surface there. I think the very interesting thing is this concept of aging population in the US. It is very clear that population that's over 65 years old spend 5 times more on medical than the demographic below 65. And so if you are going to acquire a medical office building, try and acquire that medical office building in a campus that's near to where a lot of our people are migrating to. So this is our hypothesis, and we are very confident that when we acquire a building, in 10 years' time, that building must be worth significantly more than it's worth now because of increasing demand. And without spending too much time on this slide, I think let's move on. I think the point is made.
Justin, if I can just jump in there, because it's quite an important thing that, you know, in terms of the buildings, we buy them because of the cash on cash, but we also buy buildings that have a little bit of upside. And whilst, you know, we don't often stress the point, it's important within this forum to understand the fundamentals and the numbers, because you obviously have sophisticated clients and they will ask you how we're able to add the value. Michiel will take you through later some of the value. But the one thing in the US is that there is a perception that there's no inflation. There absolutely is inflation. And certainly our buildings have an escalation built into them of 2 to 2.5% on every lease per annum. Otherwise, we won't buy the building. So what you have is a scenario that your income is rising over time compared to the inflation. It's more than the inflation. So your revenue is growing. And when you then sell the building, you're selling a building with more revenue in the future than it is today. And that's also how you get your capital growth at the end.
I think it's important to add that technology is having a significant effect on the medical environment. And when we get Henny online, it's a fascinating talk to listen to him. He has spent a lot of time trying to understand where healthcare is going in the future. And it is quite remarkable, but I don't think relevant for today's conversation. Of course, where the rubber hits the road, that is ultimately what your clients are going to want to know. And Martin, you love to talk to the slide.
Thank you, Justin. And so this is really a slide that illustrates our dividends that we have paid out per annum on all of our projects. And you'll see the consistent numbers and the consistent performance. What you'll also notice towards the bottom is if you look at Med 25 and Med 26, those two very significant projects in our world were a lot of value add. And whilst they show 5.7 and 5.9, the overall average cash on cash is well above 8%. So they start off at 5.7, they then move towards the 8 to 9 and then towards the 10%. And so that's the reason why we exist. We exist to offer people and generate good dividends for people on an annual basis paid out quarterly. In terms of the capital gain, you can see the capital gain at the end. And that capital gain, while it's a large amount, I always like to explain it in simplistic terms. Let's assume you buy a building for $10 million and you, for example, have it geared on a 65-35 debt to equity. What that means is when you buy the building, you will, for example, use 65% debt, which is the mortgage, and 35% equity. For round figures, let's say that's $3.5 million. After 5 years, we're not saying that the building will grow by 50% from 10 to 15. We say that the building goes from, call it 10 million to 12 million. So your actual capital appreciation is that 2 million profit on the 3.5 million that you invested. Hence, you can see why it's quite simple to get capital appreciation, certainly in the high 20s, 30s, and 40s.
So I think very important to add to that, Martin, just to clarify exactly what the model is. What happens is we take investment on a particular building, and just to be clear, we are now starting to do mini portfolios. And what we're proposing to you guys is that we start off on a mini portfolio, but traditionally until now, we put in a bid for a building. While we are doing our due diligence, we launch it to the market. Once we have fully raised the capital required, then we close on the building. And we acquire the building, and it runs for a period of 5 years. At the end of 5 years, our mandate as managers of that building is to sell the building. So during the period of the building, we collect all the rentals, we distribute to all the clients, and we distribute it quarterly. So clients up till now have enjoyed 2% quarterly dropped into their wallet, which is effectively a Seychelles trading account on the exchange. And they do that for the period of the 5 years. At the end of the 5 years, Michiel and his team go out and look for a buyer. We sell the building. The capital appreciation is is shared with the investors on a split depending on the type of investment that it is, and the principle is that it's normally 50-50. So us, the sponsors, and anybody on our side managing the building get 50, and the investors get 50. And that's the cool thing about this particular investment, is not only is it the cash and cash, but you stand the very good chance of making a nice upside at the end. That upside is paid out as a dividend, as everything is paid out. If you are investing through the Seychelles, that 99% of your investors will do, that will mean that it is tax-fully paid up to that point in the Seychelles. So if they are going to declare those taxes in South Africa because they're a South African taxpayer, then they would declare that as income from a foreign listed company as a dividend. So I think that gives you a little bit of, it makes it a little bit clearer as to how we operate. Just a little insight, we have a platform which is coming along really nicely. It's designed not only for the client to interact and engage, it's also designed for you as a financial advisor to be able to log on and manage your clients' affairs and see your clients' performance. So I think that's very exciting, and it depends obviously at what level you wish to operate. Just to show you, this is a kind of a typical dashboard, and we might show that in a little bit more detail later on. Quite simply, each asset is listed in a tradable security. So this is something that Michiel and the team have developed over time. We initially encouraged an investor to set up an LLC in the US. That is very cumbersome and expensive, unless it's an investor that's investing millions of dollars. So the system that Michiel and our CFO came up with about 3.5 years ago was to use an international exchange. We selected the Seychelles because of the cost and the speed of getting to market. Incidentally, the Seychelles is accredited as with the World Federation of Exchanges. So although it's a tiny exchange, it has to comply with all the same legislation as the JSE, for example, would. What we do is we create a separate listing for each investment, so they are completely ring-fenced. So there's no chance that if something goes pear-shaped, be it the company or best or medical 350, it doesn't have any effect whatsoever on any of the other listings. As I mentioned, in South Africa, we operate as a juristic rep under license 41690. We wish that the FSP would be a bit more organized, because we have been trying for the last nearly a year to get our Cat 2. But it appears that's an impossible thing, which I'm sure Magnus will concur. And then just finally, we do file in the US as Reg 506C in case you have a client that is in the US, that is offshore, that has already got accredited status, or an entity in the US. I'm not going to talk to that. So this is a typical portfolio that I've set up just to demonstrate what we think a perfect investment looks like. And the first thing is, because we do individual buildings, the reason why we do individual buildings is because clients like, especially the property people, like to see the property. They want to know what they're investing in. They want to see who the tenants are. They want to literally go and kick the concrete. And by the way, we'd encourage that. So what we're saying is that if you want to have a diversified portfolio, then invest regularly over time in each building, and you'll build up a nice spread of assets. So this particular investment, what we've done is we've shown what that looks like. Initially, the client tested, then he built up a little bit, and then he decided to do regularly, whatever it is, it's a 20 grand investment over time in every single building. Builds a lovely portfolio. Here you can see, by the way, this is his dashboard. So a client would log on and see this. You would see his earnings grow, and this is quite gamified because they like to build that up. You will see what his total investments are, what earnings he's made so far, and of course all the documents and everything is up the top here, various statements you can draw for tax, etc. And just another point is that, oops, that was not clickable. That's really all I needed to show you on that. I think let's get to the more important part of the conversation. And that is to bring in Michiel to talk a little bit about the buildings. And Michiel, perhaps you could just also touch on ODH3, which is the first product that we wish to take to market. And we have ring-fenced already for Brenthurst, a major chunk of that, and we're holding it back from the market until they've got a head start on it. But over to you, Michiel.
Thank you, Justin. From a track record perspective, Justin, if you maybe just go to the next slide. We have started off in 2014, myself and Henny, with the building in Atlanta. Just go one back, please, Justin. And so from that perspective, that's when we started. You'll see we started off by doing effectively one building a year. You can imagine we started for that 19 million building, we had to raise about 5.6 million equity. So the idea was really to build it up as we gained momentum. And really, once we reached 100 million under management in 2018, we really started to accelerate. You will see that we started to buy larger buildings. And in 2019, we did quite a number of properties. And this is really because what we have been consistent in delivering is the 8% cash on cash, as Martin alluded to, and our investors starting to see the consistency, and that is where we are now. So in 2020, early January, we bought one of our biggest building that was a $35 million project. It's really directly across a hospital, and so we're super bullish about that. So from that perspective, you can see the portfolio overall has grown. And then I think most importantly, we have also now done what we call the first full cycle deals. So the medical 1 and 2 that you see on the left-hand side, that period has pretty much the 5-year investment period in it last year, and we managed to offload those investment very successfully. Coming up next year, we are going to start offloading medical 3 and medical 5. Medical 5, we're actually going to reposition and reset the clock. And medical 7 and medical 9 is all going to be exited next year. So as you can see, we to a very large degree maintain our 5-year mandate. We're also very clear in our mandate when we do the investments that we will sell at the optimum time, and it might not be exactly 5 years on the dot. It might be a little bit earlier, a little bit later, depends on the market situation. For instance, if the exit was supposed to be July this year, you can all understand it would make sense to just delay it, that the COVID effect will basically subside. So from that perspective, we're very clear. The 5-year investment horizon is a guideline, and we are pretty much meeting it most of the time. So here's some examples of the 2 buildings that we have in Austin. And the whole idea behind this 2 acquisitions is to build a portfolio. One of our clear exit strategies is to combine buildings, and there's a very clear premium if you are selling a group of buildings versus a single building. So you can see it's very similar nature, similar locations, and that is the grouping. Maybe we can go to the next one, Justin, please. Yeah, these other 2 buildings are in Atlanta. The bottom one is pretty much our biggest equity raise that we did last year. That was about 14.2 million equity raise. This building is performing significantly. We bought it at 61 million roughly. And based on the NOI that is coming through early next year, this project will be worth more than $80 million. So very, very happy with this. And we also got a large contingent of our investors in them. The next one. Yeah, then by far the largest acquisition that we've done is in San Antonio. For those that doesn't know, San Antonio is a huge city in the United States, in Texas, that is driven by the American medical field, specifically in the medical research field for the US Army. So huge infrastructure, and these buildings are on very close to a campus of 5 hospitals. And our business plan in this specific case is the first building that you see on the left-hand side. We have converted that building from effectively an office building into a medical facility. And one of the key things that comes with that is that we had to put in a surgical elevator, and we have to add additional oxygen and water supplies as per hospital supply. And with that, it enables us to get these long-term leases that Martin alluded to. In this case, the leases are more than 10 years. and they at a premium of at least $10 per square foot. So fantastic opportunity that is just going from strength to strength in that one. Then maybe on to the next one. Yeah, then I think the first one that we did up in New Jersey is the one on the top left-hand side. Fantastic. We got Hackensack and Meridian, one of the biggest medical groups in New Jersey, has basically got a 10-year lease in that building, occupies roughly about 60% of the building. So extremely bullish about that building. And subsequently, we have bought our second building in the as we call it, the tri-states. We've got a huge demand of people that really are looking at the tri-state, which is New Jersey, New York, Connecticut, as an investment destination. We have found these deals off market because the market, from a pricing perspective, are obviously more expensive than what we found in Georgia and below. Yes, there's the building below that we just closed on, the brownish building. And then the building that we bought earlier this year in Texas, also a fantastic opportunity that we have there. What we're currently doing is there is also roughly about 45% to 50% medical, and the last spaces we are currently letting out. It's fully leased. It's just a question of building out now that we are converting. So we'll end up about 65 to 70% medical, and one of the tenants is also an insurance company with a huge credit. So it really just bodes well, and this location is directly across the Children's Hospital in Dallas. And for those that doesn't know, the GDP of Dallas and Dallas-Fort Worth is as large as South Africa. So it's just unbelievable, the growth and the buoyancy and the resilience of that market. So we're super happy to be in that market. We're looking at the moment at another one or two in that region. So yeah, Texas has been a clear favorite of us, and we also seen in the last GFC that they didn't even blink. They just went through. Now in the COVID situation, our tenants are paying, and it's just driven right through. So yeah, very strong markets that we're in. So yeah, Justin, we're very happy with that performance. And now we're entering the Phoenix market, as we alluded to, an absolute star market. It's on track to become the fourth largest city in the United States, and it is just buoyant. So yeah, very exciting to see the market grow. From a medical perspective, the market has really turned around, and we've seen the resilience, and it's almost as if COVID hasn't happened. So prices are there, transactions are there, and we obviously exploiting this opportunity.
Michiel, if I can just jump in here, and sorry, Justin, I just want to mention one other thing. You know, one of the questions we get asked is, how can you predict your cash dividends going forward? And the one thing that Michiel always manages to get is we focus heavily on triple net leases. What that means is that from a landlord perspective, the tenants pay most of the expenses. They're accountable to pay it. So what happens is, if you've got a medical office building, a MOB as it's known, we'll call it 8 to 12 tenants, and they've got long leases, those 8 to 12 numbers are cast in stone for literally 5 to 10 years. Your expenses, being primarily your taxes and your rates, etc., are also very predictable over that period. So really, you take the one less the other. That's pretty much, after paying your mortgage, what's left over, and that's what we obviously then pay to people around the world. So that's what gives it the predictability.
Excellent. Guys, so we're coming on just over for 40 minutes, and I really want to leave a lot of time for Q&A, but I thought what we would just do quickly is just show how we normally approach a client and sort of our sales process. So the first thing is this document, which we produce when we launch the property. So it is a brochureware, and basically we talk about the opportunity. We try and summarize it, and we give a few bullet points on what is the key fundamentals of it. We talk about the area, why we've invested in that particular area, the growth. In this case, you heard Michiel's story about Phoenix and this research and innovation corridor. We show the tenants and the incomes and the year-on-year growth of those particular tenants. We show the fundamentals of what the rate per square meter is versus the rate that we acquired the building. And we show very often the cap rate that we buy the building. Bear in mind, the higher the cap rate, the lower the price. So it's counterintuitive. So in this case, we bought the building at 8%, which is at least a percent differential between what we bought the building at and what the market would normally pay for it. So, you know, these are the things that are key. But that is basically the brochure. And you can see that it's quite fundamental. And then ultimately in the brochure, you have the financial summary, what we acquired the building for, all of the costs that are involved in putting that building together and maintaining it for the 5 years, the total investment, the equity required, and of course, the investment. Yeah, there's the equity investment. I think very important, and I don't want to spend too much on this because this is really Michiel's thing, and I prefer to leave it to a more detailed conversation. But loan to value, these are things that we do in order to mitigate risk. As you know, you can always increase your return by borrowing cheap money from an institution in the US because you're paying interest rates of 3.5%, whereas your investors want 10%. So the more you gear, the more your returns go up. We have a discipline. Michiel cannot move beyond a certain point in LTV. And this building is going to be a little bit higher than 57, but it'll be sitting at 60%. But all our buildings will be in that region of 60 to 65%. Debt coverage ratio is also important. If you do lose some tenants, you don't want to be in a position where you have to go back to your clients and ask for a capital call. So there is a minimum DCR, and this one is very comfortable, as you can see there. This is the split basically between the sponsor and Orbvest. Sponsor is basically the property partner on the ground, Orbvest and the investor. We have a 7% cap. So what happens at every distribution that we do, the 7% is what the client gets absolutely. If we can earn more than 7%, then we split with the investor on the same basis. And that ultimately means that our 8% that we've been maintaining over the last 6 years is probably more like 9% after we've taken our incentive. So the beauty of this thing is that we are always aligned with the client, and the biggest win for us is to improve the value of the building as we go along. And then finally, yeah, this is what a typical client that you would put in would earn. If they put in $10,000, then they would get 800 in year one, and this is the return. This is the proposed capital gain. This is the gross return, 14.5%. Once we brought the money through to the Seychelles and paid all of the taxes in the US, we managed to keep that at 13%. So 13% after tax in the Seychelles. Obviously, you have to then declare the tax in your own domain. If you're in South Africa, then you would have to do so. And then we have some mitigation points, and then obviously this little summary of what all this is all about.
Yeah.
So
just relevant for Magnus and the team is that if they have investors from Mauritius, then that is then basically tax-free because it's viewed as income generated off the Mauritius island. So a lot of our international clients, which have international structures, actually then get the dividends into that jurisdictions, and most of these jurisdictions is a tax-free environment. So very conducive for people that would like to have dollar-based income offshore.
Michiel, thank you. I was just about to ask you about that, and you're quite right. Once you set up your structures, there'll be no more taxes. So that's very, very attractive.
Yeah, the only thing, Magnus, that you obviously know in Mauritius, you just have to ensure that obviously if the client becomes a resident, there is a small amount of tax. If that resident still have an offshore jurisdiction and still repatriates to South Africa, that is not conducive for that client. So the whole idea with the offshore structure is just keep everything offshore.
Thanks for that.
Thanks, Magnus. Just quickly to finish on the documentation, I think the question is, what does it take to get a client on board? Well, this is the formal document that they signed. This is effectively a PPM. We call it a property supplement, and all of the content is in this document that they would need to, and this ultimately they'll sign. It has the structure, it has absolutely everything which people really enjoy, because these are all the particular tenants for this building and what they're earning. This is the structure, the offshore structures. So everything is declared in there, and of course they would sign this document predominantly online via DocuSign on the platform, or alternatively, they would sign it manually with you as a consultant. I think the only other document that I would like to just share is, how do we onboard a client? We have a platform that, that we would encourage people to go for, but as consultants, we can actually get a mandate to do this on behalf of the client. And this is what we do, and I'm sure that this is the way that you will operate. But just to give you an idea of what that looks like, we get the client to give us a mandate to do all the work for the client. Normally it has a disclosure in front. Obviously we can make that your disclosure, but ultimately, if we are doing the back office work for you, which is the model that we've discussed, then you know, you would have to get a mandate. You would have to mandate us as well to do that work for you. And quite simply, this is all that's required in the Seychelles. It is very standard. It's your typical KYC certified documents, passport, proof of address, bank account not older than 3 months. So nothing really onerous there. The documents don't have to be original, which is great. So we don't have to courier hard copies or inked copies to the Seychelles. This form you can type in, so we can modify it for you. Not a lot of fields that you have to fill in for the client. So it's certainly nothing like a bank document. You can see, you can mandate, the client can mandate you or us to have full control, to make withdrawals on their behalf, or literally only just to view. And then ultimately you select what you want to do, and there's the mandate. And that is really all I want to cover for today. Let's open up for a bit of Q&A.
Justin, are we not going to talk about ODH?
Oh yes, of course. Probably the most important thing of the day. Michiel, would you like to talk a little bit? Or maybe Martin, you'd like to lead into why we.
I just want to, yeah. So to everyone today, what's happened over time is that we have received tremendous interest from a lot of financial service players and also large players in the world. And what they've said to us is that, you know, when we put in a large amount of money, let's talk about the large players. Whilst you do building by building, our strong preference is, can we not just give you a certain amount of money and you diversify it for us? The second thing is that for a lot of people who are investing, specifically South Africans, they're high net worth people, they're retirees, they're pensioners. They don't want to look at every single building. They don't understand real estate. They just want to know that their money is at a low risk. So we have planned for a significant amount of time, certainly most of 2020, to launch what we call ODH, which is Obvious Diversified Holdings. And what we did was we built it that it is extremely simple for all the financial consultants to sell. Why? Because you don't have to understand every little building. What we did was we took a low risk value proposition of real estate, and we then made it even lower risk by spreading it across a minimum of 7 to 8 buildings. And so what happens is when you put in your $5,000 or $50,000 or $500,000, it goes into ODH, and then we spread it across the 7 to 8 to 10 buildings that we generally invest into. So why? Because if there is, God forbid, even a small issue with one of the buildings, it's not going to affect your overall return. And so that becomes incredibly consistent. The person almost knows with certainty, reasonable certainty, they're going to get, they call it 8% cash on cash per annum and per quarter. And what I just want to stress is that specifically for everyone today, the reason why we did it for the financial service consultants is because it is so easy to pitch. ODH 3 will be the same as ODH 5, will be the same as ODH 10 in many years to come. It's the same principle. It's real estate, healthcare, America, 7 to 8 buildings. They all look more or less like this. They all perform more or less like this. It's all for 5 years. So it becomes easy for all of you to sell without the difficult questions of the specific building.
Yeah, Martin, thank you. I think you hit the nail on the head. I think the only thing that I really can add to this is that we've also built in some specific guidelines or limits. Like Martin alluded to, we'll be investing in 8 projects. So that's very easy for a person that invests $5,000 to have exposure to 8 projects, as opposed to him or her doing it on their own. And then I think the next feature of this is that when we do the individual buildings, the cash on cash typically varies over the period of time. It's typically between 8 and 9%, and it's not always exactly the same. But in this specific case, what we did is we have pegged the return at a precise 8% return, and the surplus that we generate, we put in a reserve, which is to the credit of the investor, that in the event that, for instance, a property dips a little bit below 8%, it simply tops that up. The whole idea of this is specifically for people that would like to have a consistent income, and they would like to obviously plan with that. So from our experience, for instance, an investor can perhaps save up 1 quarter's dividend, and then from the next quarter, then pay himself on a monthly basis the spread of the 8% over the year. And he knows exactly that's what's going to happen. The second feature of this product is that when the underlying buildings are selling, the investor's investment capital in this product will diminish across time. So in the last year or so, as we sell the buildings, the relative return in terms of the initial capital relative to that building, and obviously the capital gain from that, will then be returned, so that at the end of roughly about 5.5 years, the investor will be completely out of it. So you can see here is our initial allocations. There's a lot of detail on here, but when you get the brochure, have a look at it. And then I think what we have done is we've taken some of our existing projects. The reason why there is equity available is that Obvest has its own equity. So it's not equity that we are reselling effectively. It's equity that we have ring-fenced by virtue of our underwriting fund that we make available now. And then the buildings that we're busy closing, we are already ring-fencing that with our underwriting fund for the monies. The other main feature of this investment is that we have also streamlined the process that when an investor invests in the first half of a month, the investment will be effective from the mid of the month. And when an investor invests in the second half of a month, the investment will be effective from the first of the following month. So that means that the investor's money will immediately start to work. And we have a process which we call a listing process. And once we are fully subscribed, then we do the listing. In order to accommodate investors that has invested pre-listing, we then pay interest up to the listing point, and then from the listing point we pay dividends. So the net effect is really, we want to demonstrate to investors that the money works pretty much within 2 weeks since we received it in the social. So very, very powerful for people that really would like to, as soon as possible, get income from their investments. So I think, Justin, that I think is the highlights. There's obviously quite a lot more to it, which we can talk about, but I think as a first introduction, let's do it like that. And then obviously we are available if we need a little bit more in detail training sessions if needed.
So I just want to jump in here and say that ODH, we launched ODH 1, and we thought that it would take 2-3 months to pretty much subscribe to it. We were blown away by the response. It's only to South African investors, not to anyone internationally. We oversubscribed in 18 days. In fact, Justin had to request the team to urgently put together ODH 2, which we did, and that oversubscribed in 10 days. And so with the launch of ODH 3, what has happened is that Justin has specifically asked that we ring fence a large portion of ODH 3 for Brenthurst. There is no commitments. Don't worry, you don't have to. You know, if it's not taken up, we will just then insert it into the other channels. But it is specifically, I think, the perfect kind of product, from my opinion, that just gives it a simple, easy explanation. You can get in, the documents are all the same, and it is a low risk proposition that delivers solid returns. Do we target 11%? Yes. Are we hoping that we'll do a lot better than 11% overall returns? Of course, because you've seen the underlying returns of the properties below. But in Orvis, the one thing you're going to hear consistently is under promise, over deliver.
Thanks, Martin. I think, guys, we've spoken a lot. So please, can we open the floor to the questions? And are we on mute? So Magnus, I think you've taken your mic off. So let's start with you.
Yeah, let's this, it looks very nice. We're very interested. We want to roll with it. And just before I forget, maybe I should invite Michiel to come to our planners meeting close to Lanseria on the 24th and or 25th of November, where you can actually hands-on show us how you load a client in a real time. And we'll actually put some real money in. I'll put some of my own money in and see how the process works. So if Michiel or anybody else for that matter can make it, that'll be fantastic.
No, we will definitely make the time, Magnus. So we'll be at your offices and we'll demonstrate it to you. It's a relatively simple concept. I think it's just showed once, then people will understand how it works. The whole idea is just to make it as simple as possible.
Yeah, all our planners will be up here for those 2 days. So that's the ideal time to show them hands-on how to load a client, what documentation, etc. So we'll after this, we will send you, Brian and Sue are planning that meeting. So we all 20 guys will be there. And I think let's book an hour just to go through this again. We like the concept very much, but the question is, I've got 2 questions. Where lies the risk? And there are many answers to that question. And secondly, just to satisfy myself, why do you sell the building after 5 years if it's such a great investment?
So maybe I'll actually jump in and say that when we first started and we were doing 5 years, because real estate is a long-term investment, and people were asking, can you not do a deal over 3 years? And, they were new to it. They were nervous, and they also wanted a definitive cash out point. And so we explained the 5 years. What's interesting is as we've moved along in the last year, we've also had certain projects that have got a corporate component, which are 10 years, because people are saying, I want to put my money in and let it grow. So what's interesting is when we get to the end of 5 years, a lot of our investors turn around and say, but why are we selling? It's a great investment. We're getting dividends for 5 years. We like to ensure people actually sell. They must cash out. It mustn't be paper money. They must enjoy the profit. Some of them need the profit for various things in their life. As long as we can take them from an existing deal and put them into a similar new deal and they bank their profit, that's their choice. So it is also about the timing. We just believe that in the US, it's a good time. However, as we say, there will be options going forward for both 5 years and 10 years.
Fair enough. The other risks, I would imagine, would be interest rate risks in the US. And how do you guard against that?
Yeah, Magnus, from our perspective, all our buildings have got a fixed interest rate, so we don't take any chances in that. So I think that's the one risk. In our view, the biggest risk that we see from a deal perspective is the ability to pay the bond. And so with that in mind, we have taken very specific precautions to ensure that. First of all, we like to be in multi-tenanted buildings. So if we lose 10% or 30% of our tenants, we can clearly maintain the debt payment, although we can slow down on the dividend payment. So I think that's the one thing. The second thing we do, we maintain a debt coverage ratio more than 1.8 across the 5-year period of the investment. Our banks only need 1.25. And at the moment, most of our projects are well over 2% debt coverage ratio. That means that I can lose about 30% of my tenants and I can maintain it. And then lastly, we have systematically also started to reduce our loan to value. So we would like to have solid returns with in-place tenants. So what we do with that is, it's actually counterintuitive, but if we lower the LTV, it means that we've got a larger buffer in the event that there's a major market correction, which we have to plan for just for that unlikely event. So from that perspective, lower LTV on our loan. So we moving down from 65, we're never more than that. We do debt coverage ratio and we have multi-tenants. And then lastly, obviously, we are in very buoyant market locations. We've seen that it's absolutely essential that you're in those locations, and then also a well-diversified industry location where we are. We are not in one-horse towns. So all these factors ensure that we get a fairly stable asset that can take the knocks. And then lastly, which is pretty much a bit of our secret sauce, is that we look at the tenant mix not only from the fact that there's 10 tenants, but also what type of tenants. To illustrate this fact is during the COVID situation, a lot of the, let's call it doctors, had elective surgery and non-elective surgery. And the majority of our buildings has got non-elective surgery in. That means that you have to still do it. And with the advent of the hospitals being ring-fenced for COVID patients, there was a very clear overflow into the medical office building. So matter of fact, our patient numbers actually increased. So these are the things that we ensure that income stream, because that's what you're really buying. And that's the risk that we want to protect, is that income stream must not dip.
Michiel, thanks for that. One last question. You only deal with the accredited advisors. You don't deal with the public. So the public can't come and knock on your door and say, "Oh, I heard about you. I want to place my business directly with you." Is that correct?
Yeah,
it's not correct. We are. Sorry, Justin, continue.
No, Magnus, predominantly we deal with the public at large. It is only in the last year that we really have kind of started to switch that strategy and have been signing up particular financial services companies that already are advising the client. So it's a slight switch in strategy, but at the moment, predominantly the money is coming from clients that approach us directly.
Yeah. I'll tell you why I asked the question. I mean, we've had experience in the past with, I'm not going to mention companies, with fairly innovative products that come to us. We then do a Zoom meeting and we do webinars and we do on our website and our newsletter, which is quite extensive. And they say, "Oh, thank you very much. We'll go straight to the product supplier," and the product supplier took their money and we were cut out of the deal. So we will need to devise a mechanism how that can be prevented. I mean, we can push the button, but I don't want another repeat of that again where the guy says, "Oh, thank you for the information. I'm going to pick up the phone and go straight to Obvious." And that's a little bit of a concern to us, and we just need clarity on that.
Yeah, interestingly, I can absolutely talk about that, because the problem that we have is almost the other way around. We work with a client, we get them to the 11th hour, and they say, "Fantastic, we love it, we're going to do it." We're getting a hold of Magnus to check to see if it's okay, and then ultimately Magnus gets the deal. That's the first thing. So we find it's completely the other way around. Ultimately, the gatekeeper is the financial advisor, firstly. And secondly, I think that what you will enjoy is that when you talk to a client, you'll find that they've already seen it and heard of it, because there's substantial marketing, especially in the next month or so. We're absolutely smashing marketing on every channel. So there's an enormous amount of support that we're giving in terms of the brand. So we might win a client of yours, but you'll win a lot more of ours, because they would have already been sold and they'll come to you and say, "Please, Mr. Gatekeeper, tell us if you think that we should put our money here."
If I can just add to that, in that all the businesses that I've ever run, it is essential that every client comes to us, we ask them the question, "How did you hear about us?" And they're always allocated to a specific channel or person. And so normally the person would say, "No, I was on the Zoom." "Well, what Zoom? How did you hear about us? Who did you hear from?" And they are allocated to that person for life. And we have had situations in my previous businesses in this where one of your financial planners will say that, "I've got a client and I was speaking to them, they went to Orbis." "Absolutely no problem, Magnus, we allocate them to you." We've got no issue in it. It's part of our model. And so any client of yours, you can almost be guaranteed, if they come to us, they're going to be linked to you.
All right, I'm good to hear about that. Let's, yeah, if the other guys have got some questions.
Hi guys, it's Stefan here. I've got a question for you guys. It's a practical one. How does the wallet work? You say dividends get paid out, and then after 5 years, when you sell the business or the building, the capital gets allocated to the wallet. But how do you, a client reinvest into a new building? How's that channel? How does it channel back into another building?
Good question, Stefan. So absolutely, we try not to handle funds at any point. So when a client invests for the first time, it goes into PKF Capital escrow account. When the investment is made, obviously it goes from there directly into the building. When dividends get distributed, they come back and they land in the trading account on the merge exchange, which effectively is a secure account under the control of that client, which they can interface via our website and obviously going directly to PKF, who will be their broker in the Seychelles. And so quite simply, if they wanted to make a withdrawal, they'd click a button and quite insert what withdrawal they want to make, and that money is immediately transferred to them into the bank account that they have nominated. Alternatively, they want to make a reinvestment. It's even easier. It's 3 clicks and they can select where they want to put it. So it is effectively, the wallet is the trading account at the exchange.
Thank you very much.
Justin, just to come back to that, while you were talking now, I thought of a way to circumvent the possibility of our clients bypassing us. I would suggest that if we get involved with a specific building, or you mentioned you allocated some stock in one of the new buildings, that for a month or so, when we do a launch, we find that in the first week or so is all the attention, and then it starts waning and declining, that we get some kind of exclusivity for a month before you open it up to the public. I just thought about that idea. Maybe we can work around that. So we don't want to cut off your, but if we're going to spend money and time on promoting it, and which we do extensively, we'll say, right, in exchange we have some kind of exclusivity, whether it's a month or 3 weeks, neither here nor there, but we can discuss that concept if that's okay with you.
Absolutely, Magnus. There's lots of creative ways we can do it, and we would, as I say, we bring fence that amount. I think the mechanical problem that we have is that we have to put it live on the website. But what we can do is we give you the lead time to do all your marketing and build up your client base, and then we put it live. But
okay,
let's solve that offline. There are lots of solutions.
Yeah. Okay. Thank you.
Justin, it's Andre here. Thanks for the presentation. It's really insightful. How do we earn a fee on that? Is it like only an initial fee, ongoing fee? How does that structure work in partnership with the advisor?
Absolutely. So we don't take any fees from the client. So what we declare is what the client earns net. In the beginning, we have a marketing fee that is allocated from the actual project. And out of that marketing fee, we pay whoever it is that's originating the business, and we leave a small clip for ourselves to cover our own overhead. So that marketing fee is paid once off upfront. That's how it is at the moment. We certainly have been talking about trying to make a more of a trailer commission that is more traditional with your industry. But right now, I'm afraid it's just an upfront fee on the closing of the particular deal.
Well, what is the fee right now, Justin?
Magnus, again, I think that's a discussion that we have offline. We have different levels from where we do all the work and we take all the fiduciary responsibility to where you do all the work and you take all the fiduciary responsibility.
Okay, but
I think our deal is going to be around about in the middle, because it certainly it makes a lot more sense to be in the middle, but we can talk about that offline.
Any more questions, guys?
Justin, thanks to yourself, Michiel and Martin. Just 1 or 2 practical questions from myself. First of all, can we get this copy of the slides? That's the first one. And the second one is just with regards to those withdrawals. I would imagine in that wallet, you can only withdraw the dividends paid into that wallet, not the capital.
Just your mute.
Yeah, the investment period is for 5 years. Brian, that's actually a very good question, because one of the one of the limitations of the product in the eyes of the consumer is that their money is locked up for 5 years. So yes, absolutely, they can't at this stage draw down on their capital. It is obviously an exchange, although it's not liquid. And so technically you can put your share up for sale, but there will be no market for it. However, I need to just be very clear. So far, up till now, over the last 6 years, anybody who's wanted to liquidate their interest and get out has been able to. That trading rate is over 5%. So we've had trades of 5% on the shares. And how it works is that the longer the investment runs, the closer you get to the IRR. In other words, the big cherry at the end. So the investors in the project always want to take that guy out. And predominantly what happens is it's at the same par value that he went in. So if he invested $100,000, he gets his $100,000 out. He's at his 8% along the way. He's happy. The client that buys in is going to probably have a slightly a bigger windfall in terms of the ultimate IRR, because of the window period is shorter. I hope that answers the question.
It does. Thank you.
Just a last comment on that is that one of the key things that we encourage is that when that dividends is paid, it's on the offshore account and it remains in offshore and it remains in dollar. The whole idea is to maintain it in that offshore account, and then the investors must then use that to redeploy and pretty much reinvest into the new 2 or 3 available projects. So it means that in a 5-year period, they will then be actually net invested with proceeds in about 20 projects. And you can just imagine doing the simple calculation of compounding over a 5-year period. If you repeat that for 2 periods of 5 years, you build up a significant asset value. And then the ultimate aim is to have an income flow from that. So if you have a client that wants to build asset value, that's the way to do it. If you have a client that needs income, like I said, you skip 1 month's dividend, keep it in the account, and then draw it down. On our website, you have a little form that you simply click to do the withdrawal. So it's a very, very simple process, but it's very clear that you as a financial advisor must very clearly think in terms of the 2 income or asset building strategy for your client relative to their own situation.
If I can just come in here and also mention one other thing. I think the reason why Orbis is so excited about the Brenthurst relationship is that we are predominantly the 2 big players out there in the market really telling people about offshore. And that, you know, when you get your money offshore, and you guys know specifically with your clients, once they're offshore and they're getting these good, decent returns every single month, quarter, year, it really changes their whole perception, whether they live in South Africa or they live overseas or in Mauritius. And when you overlay that with the person getting their cash dividends every quarter, what we've actually found is instead of people wanting to cash out, in fact, the opposite happens. They want to put more and more in because the equities market's going up and down over time. The rand's going up and down. Their life is filled with so much volatility. But the one thing you'll find with Orbvest and real estate in the US is it's so consistent. It's like you put your money in and it just keeps on moving at the same pace over time, which is really appealing to a lot of people out there, specifically investors with spare cash.
Great. I have another question on the and links to the stability theme. How does the separation between ownership or the assets and Orbvest, how does that set up?
I think I'm just going to show this slide. You'll see that on this slide, all the gray blocks are the actual investment structure for the specific investment. And this is completely owned by the persons that's contributing equity. Orbvest also contributes equity to deals, but this whole investment is ring-fenced and completely in standalone. This slide shows that our corporate structure are completely separate from the investment structure. And the link between the 2 is that we have obviously the management agreement from the Obvest corporate structure to the investment structure. So it's purely, let's call it a management agreement. But from an ownership perspective, I think it's very clear the ownership goes through the structures, which are then wholly owned the specific asset in this underlying, what we call the LLC.
I just want to add to that in terms of the actual physical relationship, the nuts and bolts, is that every single building, together with our partners on the ground who are managing it and actually doing the actual bank reconciliations every day and paying the dividends to themselves and Allvest and the investors. I'll give you an example. One of the partners is a strategic relationship with Lincoln Harris. Lincoln Harris are one of the largest players in America. They've got thousands of employees, billions under management. They own, I don't know, they manage many hundreds of buildings on behalf of the REITs in America. So if something ever happened to Allvest, God forbid, you know, that process would just continue seamlessly. The money would go through to the Seychelles. We've got the various channels and the lawyers that would make sure it flows through. And we specifically built it like that because of the paranoia of us, the management team, that we wanted to know it's always what we call in the vault. And the vault is separate to the company Allvest.
Look, guys, I'm happy. I've got to go, but Martin, thanks for getting up at before the fellas even started farting, and I think we must get Michiel to speak to all our planners live and in real time, and bring us all the marketing material. So we'll be in touch, Michiel, 24 or 25 of November at Avianto, which is next to Lanseria. But thank you, guys. Very excited. I think we're in. And we want to start the process ASAP.
Thank you, Magnus. I've checked my calendar. I definitely can make the date. So it's ring fence for you guys. So I'll come through, and then on this call, sometimes when we do this presentation, there's a lot of information. So if you have questions, if you think of one, just channel it to us. I'll prepare for it, put it on the slides that, you know, we can have a very efficient interaction, and I love to meet you in person. We kind of thrive with interaction, and you'll see what we're all about.
And one final comment for me, and I don't think our planners at Brenthurst know, is that Henny Besaidnet has been a client of Brenthurst for many, many years, and that's where we met. We manage part of his living annuity. So we know Henny very well, and he knows us very well. So with that, I'm saying goodbye and cheers, guys.
Thank you, Magnus.
Thanks.
Bye-bye.
Cheers, Magnus. Fantastic, Brian. Thanks for setting that up this morning once again. And we will put this video into your Dropbox or share drive that we put the DD into. So we'll share that with you, and also the deck. I think that would be it. Maybe if you don't have it already, the brochure for ODH3. And just to be absolutely clear, if we put ODH3 on the market, it would be well oversubscribed by the 24th, 25th of November. The question is, do you want us to hold it for you, or do you think that you will only really kick off post that meeting of yours on the 24th and 25th?
Yeah, thanks, Justin. Yeah, let me just have a chat to all of the guys, and then I will come back to you and have a discussion with you on that, Justin. Let me just have a chat to them and see. You know, I think that this is a very attractive alternative investment opportunity for US dollar income growth, and I think there are clients that it's going to fit in very nicely for. So let me have a chat to all the advisors, and I'll come back to you personally on that.
Fantastic. Thanks, Brian. Guys, thank you very much for all of your support, joining us today and giving us a whole hour. Really great to have you on board, and we look forward to developing the relationship further.
Great. Thanks, guys.
Thank you.
Bye-bye.
Bye-bye.